Hi everyone, it's Terrence Brandley here, and just wanted to do a quick video on some of the different loan programs that are available for renovation of properties, and both from a purchase standpoint as well as a refinance standpoint. And there's some really great loan programs out there. A lot of people are somewhat at least familiar with the FHA 203K programs, but what they're not aware of is that there's other programs available from Fannie Mae, namely the HomePath and the HomeStyle. So we're going to talk about real quick just the differences between the three loan programs, and hopefully if you're a borrower, buyer, or realtor, you'll find this a benefit and maybe learn something today. So with that, I'm going to jump right in. Okay, of the three loan programs, there's only one that can be used only for solely for purchases, and that's the Fannie Mae HomePath. And the reason being is that the properties, the reason for the loan program itself is that it can be only used on Fannie Mae owned properties. So these are properties that were Fannie Mae backed loans that have gone into foreclosure, and this is a loan program specific for those properties. Now the nice thing is they can be used on single family residence, duplex, triplex, second home, investment property, much more. There's a lot more flexibility on the ability to use this loan program on purchases than there are with the other two. And the way you can find out what properties are Fannie Mae owned is go to homepath.com. Right here, homepath.com. You can just type in your county, zip code, state, and it will bring up all the properties. You can see I just pulled up California, and there's 2,891 properties available in California. So those are all properties that can be used to for the HomePath loan. And again, I'll probably try and just go through the HomePath real quick, but again, one of the nice things is it can be used for anything from your primary residence to a second home, investment properties, multiple unit investment properties. Whereas with the other two programs, especially FHA only allows the program to be used with for your primary residence. However, it can also be a duplex, a tri-unit, 4-unit, or quad type property as long as it's your primary residence. And the Fannie Mae HomeStyle purchase and streamline can be used for a primary residence, a second home, or vacation home, but it cannot be used for a duplex, a triplex, or a quad investment property. Can only be used. So it can be used for an investment property if it's a single family residence or it's a condo. But if it's a duplex, triplex, or quadruplex, it will not qualify under the Fannie Mae HomeStyle product. Okay, when it comes to the down payment, this is where, in my opinion, FHA, the 203K is a great program, both from a purchase and refinance standpoint. Is that you only have to put 3.5% down, low down payment. Now, the Fannie Mae HomePath, if it's your primary residence, you only have to put 3% down, so that's pretty good too. Again, the only difference is that you have to be purchasing a Fannie Mae owned HomePath property, where FHA you can purchase any or most properties, I should say, but you're not limited to just the Fannie Mae owned properties. Just going down it, if you're going to, for the Fannie Mae, the HomePath, if it's not your primary residence, then you'll be required to put 15% down for a second home or investment properties, as long as it's one unit. Again, one unit being a single family residence, a condo, a townhouse. And if it's a multiple unit, duplex, triplex, quadruplex, then you'll be required to put 25% down. And then the Fannie Mae HomeStyle, or the Streamline, are a little bit more restrictive in terms of the down payment that's required. 20% down if it's your primary residence or a second home, and if it's an investment property, it's 25% down. So a little bit more required for the Fannie Mae HomeStyle loan programs. Now, in terms of gift funds, and where that comes in is obviously into the down payment. So if you don't have a down payment, you have a family member that loans you the money, borrowed against 401k, whatever it may be. The 203k program allows for, and it's pretty lenient in terms of the 203k. The only thing that it can't be seller or builder or realtor finance. So anyone that's attached to the transaction can't contribute to those gift funds. Other than that, you can get it from just about anybody. And again, all it has to be is just trackable funds. So it can't be cash under a mattress. Okay, when it comes to gift funds for the Fannie Mae HomePath loan program, the only gift funds that are allowed are if it's going to be your primary residence. So much like the 203k, if it's going to be your primary residence, then gift funds are allowed for the 3% down payment. However, if it's going to be investment property, second home, you're going to be required to have the 15 to 25% in terms of the down payment, and gift funds won't be allowed. And then finally, the Fannie Mae HomeStyle, and gift funds can be used for owner-occupied primary residence, again, much like the HomePath. So again, it will allow for gift funds. So if for the 20% down, you can have gift funds for that. However, you will not be able to use gift funds for the 2 to 4 unit an investment property. I take that back. As long as it's your primary residence, you can. So as long as it's primary residence, you can use it for the 20 and 25% down. If it's a second home or investment property, you will not be able to use the gift fund. So I just want to make sure I clarify that. Okay, the mortgage amount is based on, for all three of the loan programs, is the same. It's going to be based on the completed appraisal value. So that means the appraisal after all of the renovations are completed, or the total acquisition price, which is the sales price, the purchase price, plus the renovation cost. And it's going to take the lower of the two. So meaning, if you purchase a house for $100,000 and you do $35,000 in renovations, that's a total of $135,000. And if the completed appraisal comes back at $175,000, they're going to do the mortgage based on the lower of the two, which is the sales price plus the renovation, which is $135,000. So, and in terms of mortgage insurance, obviously with the Fannie Mae HomeStyle loan program, you're required to put at least a minimum of 20% down, so there's no mortgage insurance there. However, with the Fannie Mae HomePath, you can only put 3% down. You can get away with, I should say, putting only 3% down, and there's no mortgage insurance. Now, again, you're restricted to Fannie Mae owned properties, but that's a pretty good deal. And then with the FHA 203k, again, a minimum down payment of 3.5%, and if you have less than 20% down payment, you will be required to have mortgage insurance. And one side note, there's a recent change to the FHA program. It used to be to where after a certain period of time, let's say 5 years, you could refinance out of the mortgage insurance. However, now, I believe it was sometime in April, May, maybe in June, but of 2013 here, they're requiring you to have mortgage insurance for the duration of the loan, so 30 years. Now, that doesn't mean that you can't refinance out of that 203 FHA program into a conventional loan, but again, it's just some side note to be aware of with that. Okay, and finally, to close this out, we're going to talk about, and this is really kind of the meat of the programs in terms of the maximum amounts that you can use for the renovations and the repairs to the property. I'm going to start with the HomePath just because it's pretty straightforward and similar to the others, but you can basically your maximum allowed renovation is up to 35% of the completed value. So again, that earlier example used, if you purchase the property at $100,000 and you put in $35,000, which happens to be the limit here and why I use that amount, you're kind of limited. Now, the other part of it is that you can only use it for paint, remodeling. You can't do anything structurally, so you are kind of limited in terms of what you can do. And again, that's pretty similar to the FHA 203K Streamline. Again, you can use up to $35,000. Again, kind of it's all remodeling, what I like to call lipstick on the pig, although that's probably a bad terminology. But you can use it for paint, tile, things of that. But you can't do anything structural. You can't add a bathroom, move walls, etc., landscape, anything like that. So from that standpoint, those two are very similar. Now, the Fannie Mae HomeStyle, again, has that 35% cap on their Streamline program, but you can do structural changes. You can use it for landscaping, appliances, swimming pools. They have a lot more flexibility, and probably because you're putting much more of a down payment, which is why they'll allow much more flexibility in the spending of the reservation or the renovation, excuse me. In my opinion, the best one is the FHA 203K, at least in terms of the amount of funds that you can use, because there's no maximum. They don't have a maximum amount. You don't cap you, where all these other programs cap you $35,000, and $35,000. The Fannie Mae HomeStyle, again, will allow you to do all the way up to 50% of the completed value, which is great. But again, you have a much higher down payment. So when it comes to the ability to put a low down payment and have no cap on the amount of funds, and the ability to do structural repairs, add square footage, add rooms, add bathrooms, landscaping, appliances, everything, this really gives you the best bang for your buck and the most ability to go out there and find a property that may be in dire straits, or maybe on a great lot, but just too small of a square footage, and you can add bedrooms and bathrooms. This is, in my opinion, one of the best ones, because again, you're not capped by the amount of the $35,000, which really caps on most of the programs. It just gives you the most flexibility in what you can do with property. So at any rate, that's my quick video on the three. If you have any questions, feel free to contact me at 888-GO-TO-LOAN or tbrandley.com.